The financial foundations upon which millions of households have built their lives are facing pressures that have not been experienced in a generation. Across the United Kingdom, property owners who once considered their homes secure assets are confronting a combination of economic forces that have fundamentally altered the landscape of homeownership. The period stretching through the mid-2020s has brought into sharp focus vulnerabilities that remained hidden during the long era of low interest rates and steadily rising property values. What is unfolding is not a single dramatic event, but rather a gradual tightening that is squeezing household finances from multiple directions simultaneously. The mortgage market has undergone a transformation that continues to ripple through millions of household budgets. After more than a decade, during which borrowing costs remained historically low, the shift to higher interest rates that began in 2022 has worked its way through the system as fixed-rate deals have expired and homeowners have been forced to refinance at substantially higher rates. A household that secured a 5-year fix at around 2% in 2019 or 2020 has faced the prospect of remortgaging at rates 2 or 3 times higher. On an average mortgage, this can translate to increases of several £100s per month, sums that many budgets simply cannot absorb without significant lifestyle adjustments, or, in more severe cases, genuine financial distress. The scale of this remortgaging wave has been substantial. Millions of fixed-rate deals have already concluded, with millions more scheduled to expire through 2025 and 2026. Each cohort of expiring deals brings a new group of homeowners into contact with current market rates, spreading the impact across time rather than concentrating it in a single moment. This staged exposure means the full effects continue to build, with household budgets being squeezed progressively as more and more owners transition from the protected environment of low fixed rates to the reality of current borrowing costs. Property values themselves have entered a period of uncertainty that differs markedly from the reliable growth that characterized earlier decades. While outright crashes have not materialized in most areas, the stagnation and modest declines experienced in many regions have created a new category of risk for those who purchased at recent peaks. Homeowners who stretched to buy with minimal deposits during the price surges of 2021 and 2022 may find that their properties are now worth less than the mortgages secured against them. This negative equity position does not immediately cause problems for those who can continue making payments and have no need to sell, but it fundamentally alters the household's financial flexibility and creates genuine danger for anyone whose circumstances change. The interaction between mortgage costs and property values creates particular difficulties for certain categories of owner. Those who extended their borrowing to the maximum permitted by lenders, confident that rising values would quickly build equity, now find themselves in exposed positions. If both higher payments and reduced property values occur simultaneously, the household faces a double pressure that can rapidly become unsustainable. The options available in such situations are limited, with selling potentially crystallizing a loss, and remaining in place requiring the continued meeting of payments that may already be straining the budget to its limits. Employment conditions add another layer of uncertainty to this picture. While unemployment rates have not reached the levels seen in previous recessions, the quality and security of work has shifted in ways that affect household financial resilience. 0-hours contracts, gig economy positions, and fixed-term employment have become more prevalent in certain sectors, reducing the predictability of income that mortgage commitments require. Even those in permanent positions have faced wage growth that has struggled to keep pace with inflation over recent years, meaning that real incomes have declined even as nominal salaries have remained stable or risen modestly. The cost of living beyond mortgage payments has itself increased substantially, creating competition for household resources that leaves less available for housing costs. Energy bills, while somewhat reduced from their 2022 peaks, remain elevated compared to pre-crisis levels. Food costs have risen across most categories. Transport, childcare, insurance, and council tax have all increased, in many cases faster than incomes. A household budget that once balanced with room to spare now operates with minimal margin, meaning that any additional pressure, whether an unexpected expense or a reduction in income, can tip the balance into genuine difficulty. For older homeowners, particularly those approaching or already in retirement, the situation carries its own particular characteristics. Many in this group own their properties outright, having paid off mortgages during their working years, and might appear insulated from interest rate pressures. However, this security can be complicated by other factors. Those who released equity through lifetime mortgages or similar products face compound interest accumulating against their properties. Those who rely on pension incomes that have failed to keep pace with living costs may find themselves gradually depleted of savings despite owning valuable assets. The theoretical wealth contained in property proves difficult to access without selling, a decision that carries its own complications regarding alternative accommodation and the emotional attachment to long-term homes. Regional variations in these pressures have created a patchwork of experiences across the country. London and the Southeast, traditionally the most expensive regions, have seen some of the most significant price adjustments as affordability stretched beyond sustainable limits for many buyers. Areas that experienced rapid price growth during the pandemic, as remote working enabled movement to previously less expensive locations, have in some cases seen those gains partially reversed as the initial enthusiasm faded and local economies failed to develop at the pace anticipated. Industrial areas facing ongoing economic restructuring have seen property markets reflect the uncertainty of local employment prospects. Landlords, who form a significant part of the property-owning population, have faced their own version of these pressures. Higher mortgage costs have squeezed yields on rental properties, particularly for those who entered the market with high levels of leverage during the low-rate era. Regulatory changes, including alterations to tax treatment and increased requirements around property standards, have added to operational costs. Some have responded by selling properties, reducing their exposure, but in the process removing rental stock from the market. Others have sought to pass costs through to tenants, achieving this where market conditions permit, but facing void periods and tenant resistance in areas where the rental market is less constrained. The construction sector provides a leading indicator of confidence in the property market, and the signals from this industry have been mixed at best. House building rates have fluctuated as developers have adjusted to changing market conditions, with some scaling back projects in response to reduced buyer demand and increased construction costs. The supply of new homes coming to market affects overall price dynamics, and constraints on new building can provide some support to existing property values, even in challenging conditions. However, reduced construction also limits the options available to those seeking to move, potentially trapping households in unsuitable properties or preventing the formation of new households altogether. The psychology of property ownership in the United Kingdom has long been tied to assumptions about continuous value appreciation. Generations grew up with the understanding that property represented not just shelter, but a reliable store of wealth that would grow over time, providing security in retirement and a legacy for future generations. This assumption, while never guaranteed, was reinforced by decades of experience in which it largely proved accurate. The current period is testing this assumption in ways that may prove temporary or may represent a more fundamental shift in the relationship between property and wealth accumulation. Mortgage arrears and possessions, while not yet at levels seen in previous housing downturns, have shown increases from the unusually low figures recorded during the years of emergency low rates. The lag between financial pressure beginning and these outcomes manifesting is typically measured in months or years, as households exhaust savings, access credit, and make increasing sacrifices before eventually falling behind on housing costs. The trajectory of these figures through 2025 and 2026 will provide important evidence about the depth and breadth of distress among owner-occupiers. The interconnected nature of the housing market means that difficulties in one segment can propagate to others. Owner-occupier distress can lead to forced sales, increasing supply, and placing downward pressure on prices. This in turn affects those not in immediate difficulty by reducing their equity and options. Falling prices can also affect lender behavior, with institutions becoming more cautious about who they lend to and on what terms, potentially excluding marginal buyers from the market entirely and further reducing demand. These feedback loops can amplify initial problems, though they can also work in reverse when conditions improve. For families with children, the stakes involved in housing security are particularly acute. Disruption to housing can mean disruption to schooling, to social networks, and to the stability that children need to thrive. Parents facing housing pressure often absorb significant stress while attempting to shield children from awareness of the difficulties, a burden that affects mental health and family relationships. The possibility of having to move due to financial necessity rather than choice removes agency from families who may have carefully selected their location for reasons related to employment, family connections, or educational opportunities. The policy environment provides some supports, but also constraints on what assistance is available to those in difficulty. Safety nets exist for the most severe cases, but the middle ground of households that are struggling, but not yet in crisis, often falls outside the scope of meaningful intervention. The political sensitivity of housing costs and the complexity of factors driving them mean that significant policy shifts tend to occur slowly and with effects that take years to fully manifest. In the meantime, individual households must navigate the current reality with whatever resources and options are available to them. What the coming years hold for property owners across the United Kingdom depends on a complex interplay of factors, including interest rate trajectories, economic growth, employment conditions, and the decisions made by millions of individual households. The pressures currently being experienced are real and widespread, though their ultimate consequences will vary enormously depending on individual circumstances. Some will navigate this period without significant difficulty. Others will face choices they never anticipated having to make. The property market, long considered a source of security and wealth, has become for many a source of anxiety and uncertainty, a shift that affects not just finances, but the very sense of stability upon which daily life is built.